Good afternoon, everybody, and welcome to our 18th in a series of webinars on SAP RAR and SAP leasing. We will get started in a couple of minutes. We have a number of people who are joining last minute, so we'll get started in 1 to 2 minutes. Thank you again for joining. All right, ladies and gentlemen, I think we'll get started. So good morning again, and thank you for joining our webinar entitled Dual Reporting, How SAP RAR Facilitates the Gathering of Key Data. I'm your host and moderator for today's webinar, John Froelich. I am the VP of Marketing and Strategic Accounts, and I'm excited to be back here with Chris Ritterhern, our Director of Solutions Architecture, and Hans Christian Metz, our Senior RAR Consultant and member of our COE. Joining us also today, we have Trevor Lovegrove, who is our Head of Product Development Team, and will be speaking with us about dashboards. As we get closer and closer to the January 1st deadline, the team and I hear more and more clients asking us about 3 key subjects. How can I get ready on time? Should I start focusing on disclosure reporting right now? And the answer is yes. And what about dual reporting? So today we're going to focus exactly on that. Last month we looked at disclosure reporting, and we will continue to focus here today on dual reporting. So let's get started. Chris, next slide, please. So before we start, though, I do want to cover, as usual, a couple of quick housekeeping items. Number 1, this session is being recorded. Everyone but the presenters are on mute. You can ask questions throughout the session by using the question area, which you see circled here, and we will respond to your questions either in real time or reach out to you after the webinar to answer those questions. I encourage you to tweet to hashtag RevRecReady with any comments or thoughts throughout the presentation. And certainly, if you do want to download a copy of this webinar or any of our 18 or so other webinars on RevRec or leasing, please feel free to go to our homepage, www.bramasol.com, go to the resource section at the top right corner, and you will see our resources. You can also download our ebooks, blogs, and other content that I know over 2,000 people have viewed so far. So thank you, and I look forward to that. Chris, next slide, please. So today we will be talking about dual reporting. I've already talked a little bit about the housekeeping and intros. We'll do a little bit introduction of reporting and the dual reporting topic. And then Chris and Hans will dive into a more detailed discussion of dual reporting. And then we have the pleasure of being joined by Trevor Lovegrove. Trevor will be focused on showing us some of the reports that Bramasol has delivered to support these, as well as some of the dashboards. This will be a sort of a sneak peek for all of you who have joined us into what we have available, and we'll talk about our process going forward. And then we'll wrap it up. So Chris, next slide. I introduced myself. I am the moderator, John Froelich. We have Chris Ritterhern on here. Chris, you all know, he has been with us for over 25 years of experience and is a leading expert on RAR. He's delivered, gosh, Chris, what, 3-4 dozen different demos in varying complexity on RAR, and is considered pretty much an expert, and has delivered presentations at Sapphire, and other venues as well. So welcome, Chris. Hans Christian Metz is a frequent guest on our webinars and has had the distinction of having helped deliver one of the first SAP go-lives and subsequently working on many of the projects throughout the U.S., both as a hands-on individual, but really as an expert in SAP RAR and finance. And finally, we have Trevor Lovegrove. Trevor has a unique experience both around leading many of our initiatives around dual reporting, disclosures, and operational reporting, but Trevor has over a dozen years of cloud-based experience and is our point person on S/4HANA Cloud. So, yeah. All right, Chris, next slide, please. Before we get started into the meat of dual reporting, I just thought it would be important to cover a few major topics or concepts. You know, in meeting with clients, attending events, and talking with the Big Four, we hear again and again several themes around reporting. The first one of those themes is this whole process is more than just an accounting change. Just because the monetary impact is immaterial doesn't mean that the requirements to follow the five-step model are immaterial. What we often find is a lot of customers, and we'll talk about this in a minute, find that yes, the actual timing and impact of revenues may be quote-unquote immaterial. However, the process of getting there and understanding why it's immaterial and backing that up is not a small exercise. Reporting. One of the big issues is always reporting. One thing to keep in mind, folks, is that in the past, while you may have done a great deal of reporting with regard to 10Ks and 10Qs, it was usually in the 10K where you spent most of your time on the detailed disclosures. In the new regulations under ASC 606 and IFRS 15, you have to use that same level of scrutiny in the quarterly reports as you do in your 10Ks. And it's all about two things. Number one is disclosures, talking really about the why of how you chose and what's going on in your financial statements, and also the dual reporting. So for those of you who have chosen the modified retrospective approach under ASC 606 and IFRS 15, you will be required to do at least 1 year of dual reporting, which is reporting under ASC 605 and 606 simultaneously, and talking about the differences and variances, and we'll talk about that. Finally, talk a little bit about other critical regulations. Remember that while you may have to be compliant with ASC 606, what you really need to do is make sure that not only are you compliant, but that the processes and controls you put in place are SOX 404 compliant. You need to also make sure that the reporting that you do complies with and follows SAB 74, which are the reporting requirements. And we'd also suggest that you take a look at SAB 99, which is the staff accounting bulletins from the SEC on materiality. While it speaks to specifically areas of materiality and rules of thumb, what it suggests very clearly is that 20% is not an immaterial amount of revenue. So for customers who say, oh, well, you know what, this is only representing 20% of my revenue that I have to cover, it's really immaterial. I think what you'll find is both auditors and the SEC in particular will disagree. So next slide, Chris. Again, we know that the heart of the new regulations is the five-step model. As I said, a lot of people are spending time on step 5, and not enough time on steps 1, 2, 3, and 4. And one area in particular that we're hearing a lot about is, and we found out in a recent interview with Ford, Google, and Lockheed Martin, that they said one specific area is this concept in step 1 of contract with the customer. Identify the contract with the customer. And a lot of our customers are finding that just identifying who the real customer is takes a great deal of time and thought. So remember to think about that, and we'll talk about more of these things in detail in future webinars. What we also hear is that companies who only look at step 5 are missing the fact that they have to comply with 1 through 4. That's okay, keep going. SAP RAR is built from the ground up to do all of this work. The idea is that it simplifies and automates. You bring in your revenue documents, invoices, and bills, and SAP RAR automatically makes all of the adjusting journal entries to ensure that you are compliant with ASC 606. So with all of that, what I will do is transition over to my friend Chris Ritterhern. Chris, take it away.
Thanks, John, and appreciate that nice introduction for what we're going to be doing and about the things that I've been up to, certainly, and also Mr. Metz out there. We're out there working with a lot of clients, working through a lot of different scenarios and answering a lot of questions and seeing a lot of different hurdles and considerations that folks are having to deal with as a result of the new regulation. Today we're going to be talking about dual reporting, and before we get into actual what it looks like and how it lays out, we want to talk briefly a bit about the dual reporting and some aspects to consider. And Hans, you had some thoughts here about these aspects to consider when we get into dual reporting.
Yes, hello. So I think this is probably one of those webinars where we have to give a lot of background because really what we're covering, what we can cover in a webinar is but a small slice of the issue or a very specific topic or area in that overall context. And I think we have to look a little bit more at the context. So first off, maybe to make that clear, so we are not really, we're taking we're taking a very specific approach here for the dual reporting. We're doing account-based. You could also do ledger-based, but we're doing it account-based, so be prepared for Chris to later on show you a lot of numbers with accounts. These will not be your accounts, obviously, but bear with us and try to follow the outline logic. Chris is very good in explaining that. Beyond that, so by saying that we're not looking at ledger-based versus account-based, so we are not really looking at parallel accounting per se, okay? So the question is, what are we really looking at in the context of RAR as a, if you will, a specific case of dual or parallel reporting or accounting? So first off, we can use the dual reporting out of RAR or related to RAR for ongoing comparisons. So that is obviously ongoing comparisons a wide term. One thing that in my mind falls under that is actually this whole question of modified retrospective or full retrospective. Because saying that is one thing, you have to build it and report on it. That's another thing. So you have to basically look at data that RAR has processed for, in our case, typically, right, the old ASC 605 and then another one under ASC 606, okay? So that's kind of like an ongoing comparison for however long that is ongoing, but it's ongoing. Then we have a second distinction, and that's really for reporting, right? So statutory reporting. The second question why you could use or why you could deal with the type of reporting we're going to show here is because more for parallel run. So many of our customers have built into their project plan, specifically those that were earlier than you might be, but so several of our customers that had enough time basically built a significant parallel run into their project plans, even if they may not report that data as part of the statutory reporting. So the actual start from reporting perspective external might be later. So that is primarily related to testing and validation, right? So, and that's again, like I said, there's a difference between the parallel run here and the dual reporting. The dual reporting we're going to be talking about is a little bit neutral. We can use that during a parallel run for testing purposes. We can use it for the ongoing comparison for modified and full retrospective reporting. And then lastly, and that is maybe also giving you a little bit background because we have a lot of questions around that, and I think that several projects, many projects are getting into the stage where they have to deal with this, is how SAP actually specifically in RAR handles the whole process around quote-unquote migration. And as I think most customers that have to deal with it, that have looked into it, have found out by now, migration is a very specific term and a very limited term in SAP RAR. Migration really only means bringing in data into RAR. That's all it means. So the question is, well, once you've brought the data in, the question is, what data did you bring in and how are you actually getting to the new accounting principle? If you bring in, for instance, your old contract information from the operational system and you actually then run in parallel, right, for whatever reason, for the modified retrospective, for instance, well, then at some point in time or other, right, you will say, okay, now I'm switching to my new. That is transition. So that's the clear distinction. Migration is just bringing data into RAR. Transition is switching between accounting principles. And this dual reporting can become important for you. So many of our customers, maybe to say that also clearly, many of our customers, and I think actually might even be the majority of overall globally of SAP RAR implementations, have actually not followed the standard migration transition approach, specifically not the transition part of it. So, and one reason why you could have dual reporting is because you want to make use of specific functionality that SAP says comes for the transition. For instance, the catch-up postings that you need as opening balances for for your reporting, right? So these postings that you have to do to retained earnings. So under 605, you have deferred 60. Under 606, you have to defer 40, right? And that difference, where does it go? Well, it has to go according to the guidelines, obviously, into retained earnings, right? And we can actually use RAR even if you're not really building 605 in RAR by bringing in data for 605 and then basically immediately transitioning. So what I would call the immediate transition, that is not an SAP term, but I would call it that, basically just in order so SAP can prepare those postings for you. So that is another very specific case for dual reporting, but the advantage really is there maybe not even so much the reporting, because the assumption is you're never going to post the old accounting principle into RAR, but the assumption is that you're using the transition tools. So now I hope that wasn't too much of background, but I think it's really necessary because we're looking at a very small piece here necessarily because we don't have the time. In a project, obviously, we will have to deal with everything, but in a webinar, we can only look at a specific piece of that. So maybe back to you, Chris.
Yeah, that's right, Hans, and appreciate that. And as we go through this, Hans and I, we were going through a number of practice runs for this, and we quickly realized that in articulating how this dual reporting operates, there's a lot of very detailed, very specific elements that we had to take on assumptions and also based on our experience in order to portray a realistic scenario or a scenario that at least approximates some of the things we've seen out there. But one of the things that we're finding out there is that for every company we talk to, their understanding and version of dual reporting is unique to them. And so we picked one that with one scenario we consider at least something middle of the road, and that's what we're going to be showing you today. So here's how we've set up our scenario. We've got a standard sales order. We're using SAP ECC sales orders. When that's created, RAR will automatically create both the 605 and 606 functionalities. Now, we took one of our in-flight systems, so you will see 606. You'll see the abbreviation IAS, but that's really 606. And the gap is really 605. It has to do with that's the key, and once you have some transactions underneath it, you can't switch your primary key for those of you who know SAP land quite well. From there, we did the respective delivery and invoicing against that sales order. And then we ran postings into the GL from RAR. So this is the RAR GL posting. And then we're also taking the step further. We're going to show you the impact to the income statement and the balance sheet as a result of that activity. And we're going to focus initially on the posting results so that you can see what happens as we go through this. Now, as usual, I've put copies of the screens in this slide deck so that for those who don't attend this webinar, they can actually see those slides, and for those that are attending the webinar, you'll have a copy of the screens as we go through here. So let's talk about this for a moment here, and let's look at the SAP system here, and let's bring that up. Okay, so let's look at our sales order first. So we have A sales order, very straightforward, no great shakes. I'm not going to spend a lot of time on this one here, but just so you can see the genesis of this document. So here we have 4 devices, 2 of which are event-based and 2 of which are time-based. So no great shakes there, and then I'm just going to point out one aspect. For example, on the media service, we set the billing plan and builds for the first month invoice here. So just understand that's our basis here, and let's minimize that just a little bit, and let's look at the created RAR contracts as a result of that. So now I'm in my RAR system, and here's the document I searched on. And you can see here that both accounting principles are created. And understand that this, although it says IAS, that's the 606 flavor, and here's the GAAP flavor. Let's take a look at that real quick so you can see the difference. So let's look at the 605 flavor. And in the 605, which is the as-is, you'll notice that everything is what it states. The contract price and the selling price are the same. There's no allocation. There's none of that taking place. Whereas if I go and look at the 606 version, you'll see that there's bundling, allocation taking place. That's if you look at the recognized amount column, that's the big difference right there. I'm going to go back to 605. You'll see recognized is the same as the sales and contract price. I'm going to go back to 606. You can see there's the allocation taking place per the 606 guidelines. So that's the difference. It's the same contract. We had it go both ways. There are different techniques to get it to redirect like that, by the way. A standard feature is the way to do that, and how you feed into the actual POBs, you require an additional piece of logic in order to get that to fly correctly. It's very straightforward. It's a standard part of RAR that you need to enable so that you end up with that. Potentially, you could have 3 accounting principles show up here, and that is IFRS, 606, and 605, right? You could have all 3 there potentially if you wanted to, for purposes of, as we were talking about, the parallel and dual reporting functionalities. So let's go back into the SAP system and start looking at some of the results of what's happened out there. So I'm back in my SAP system here. Let me just minimize this screen here. And let's look at, before I take off on this one, let's look at the document flow. And you can see here, there's been the delivery, there's my invoicing, and then here's the invoicing for the monthly elements, by the way. It's 2 different invoices. It doesn't make it from that perspective. So we ran the posting in RAR, and as you understand, posting in RAR is composed of 3 steps. They're generally considered, they're all background steps, and they take off. So we've run those, and let's take a look at the first posting from the 605 perspective and see what that looks like. So here we go. We're going to take a look, and let's look at the 605 side of this. So here's the 605 posting, and what I'm going to do is I'm going to total it up so you can see it by account and subtotal it by GL account. So just keep this in mind for just a moment here, and we're going to bring up now the 606 posting so we can look at that distinction now. So let's go over here, going back into the same place, and let's take a look at the 606 posting and start to talk about some of the differences that we see there. So same RAR document as our Genesis. And again, we'll run the total so that we can look at it by GL account. And let's talk now about what we're starting to look at here. I'm just expand this out so you can see it a little bit better here. Okay, if I pick the right ones, I know, Hans, you're probably looking at it saying, those don't look like the right numbers. And,
yeah, I mean, what you can see from this,
I'm going to fix that real quick here.
All right, let's see.
There we go.
Too much testing, huh?
Yeah, I think that's what it is. Okay, there we go.
Yeah,
okay.
So what you can see obviously is, so you can obviously see, and that's what I mentioned before, we're doing account-based here. So that's actually the nice part of it, so you can directly easily see without having to toggle it to a different ledger group and so on. You can directly see the different accounts. So for instance, we have as a receivables adjustment account, which usually starts our story, right? We have on the one side 225010 and on the other one 225012, and then so on for the revenue as well, although actually for the revenue we have some overlap, and our revenue accounts obviously are not very well described, right? It doesn't say like medical device or media device or whatever we have there. But you can see there should be different accounts, right? And we basically split it up by that. The document itself actually tells you obviously only, the correction piece, so the receivables adjustment, and then also the allocation piece, which is the revenue adjustment, right? And if you look on the left-hand side, like Chris said, we actually have no allocation, so this is exactly the numbers as we had them individually, right? So, and yeah, and on the right-hand side we have allocations, and also notice one difference, and Chris, do you want us to discuss it here or later, the question about difference between due date? I could actually
also let's go ahead. We ran that list, and that's actually a nice difference to look at also.
Yeah, so you notice that we have a balance here on the receivables adjustment, and this brings up a interesting discussion that I had with multiple customers already, and that is actually, and also with SAP, right? So SAP assumes, right, to be very clear on this, frank and clear about this, SAP assumes that new guidelines means that you are accounting for your consideration, for the consideration that you are about to get, that you're supposed to get, that is contractually agreed upon by due date. So it is not the event date when you issue the invoice, but it is when that invoice is due. So in that case, you end up with a transitory position, because if we already want to recognize revenue, which we do here because we have fulfilled, right? So Chris has posted the delivery and so on, and we have time-based, right? If we already recognize revenue, that leaves you with the question, well, if we can't yet fully really recognize the consideration, how can we account for that? And that is basically, for us, it will mean that we have a balance in the receivables adjustment account. If you don't do the due date, right, you do the left-hand side where you can see, well, we have the same situation by and large, right? We have revenue recognized and so on, but we don't have a balance there. That is because, well, there we don't have a, we go by invoice date. A lot of customers tell us actually that's not what they want, right? And what you have to do then is in configuration, we don't have to go there now, but there is a configuration setting around the accounting principles, and effectively you have to be a little bit off the recommendation that SAP does, because SAP, like I said, assumes if you want to have contract asset, contract liabilities, and new guidelines, it's due date. If you don't want that, you basically have to use a different setting on the accounting principles. So, and I think that's for the individual document, that's everything here, right, Chris?
And I think that the next point we get to, let's go look at the result now from the income statement and also from the balance sheet. So we're going to go into SAP financial reporting, and we're going to look at the impact from an income statement perspective, and look at a couple components here, not so much on the income, we'll look at the balance side, and we'll talk about the concept of Part A and Part B. So you can see immediately here that on the 605, and I'm intentionally leaving this screen layered here for just a moment. If you noticed here on the 605 side, which is highlighted on my left here, I have one of the accounts here, and if I drill into that particular account and look at some more detail, let's look at the 1-1 account, and I'll just sort the postings. You can see here, this is where this particular document, this is on the left here. I know it gets a little fine-tuned here. Bear with us, posting document 29, and you can see here's it's a posting effect to that particular account, because we've designated that in account determination to be the updated account here. Similarly, if we were to look at the other side of the equation, the 606, you can see, for example, that other counts are being updated here. For example, we can see 000, and also now we have the adjustment up here in the 2250. 22512 account. And again, we can see that effect here as we start to look into the revenue adjustment accounts and the recognized amount as we look in here. Let's switch over here. Before I do that, let's look at the 606 side of this particular report here. So this is the income statement, but let's go over to the balance sheet where things get a little more interesting. They're also very interesting in the income statement, but really let's look at the impact from a balance sheet perspective. So now we're looking at this impact now to the balance sheet, and you can see there's an immediate difference here. I'm going to highlight, I'm going to switch between, here's the 605 balance sheet, here's the 606 balance sheet. Back to 605, and you can see there's one set of numbers, and here's 606. And one of the things that you're looking at here, let's look on the 606 side for just a moment. If you notice here that in my posting, and this is the 605 posting here, and I appreciate you doing your best to stay with us here as we switch back and forth so that you can see the distinctions between the two. If I look at the 606 posting, you can see here, there's that amount of 1028.10 that went into a contract asset. Now, if I come over here and drill into that and then highlight that document, I'll see that 30 document posted right in here, and there's the amount that it posted in. With some differences we didn't add in that you can see here. So here is one of the distinctions you're seeing here. And Hans, did you want to talk about what we're looking at in terms of some of the numbers as contract asset and also the liability aspect that's going on as a result of the 605 and 606?
Yeah, so you may obviously, your mileage may vary. You may handle that differently in financial reporting. Right, so we have in our system, we have obviously a multitude of contracts that have varying balances. You could even have, if you set up your system, and I think actually most of our customers have us set up their system like that, post by performance obligation, and then you would get a contract asset and a contract liability possibly out of the same contract. Right, so so that's basically what you can see here. It's a balance sheet position, right? Yeah, and that's basically, I mean, as you all know, just general catch up for those that might need the background. So basically, the contract asset liability is simplified as the difference between the consideration and the revenue that you were allowed to recognize, right? So.
And then notice if we look at this on the 605 side, that we have the accounts of unbilled receivables and deferred. Whereas if we look on the 606 side, we have the concept of asset and liability now. So that's one of the differences here, and I think that's one of the things that we're hoping the folks would see out of this is the distinction about where 606 is saying that it needs to post various values based on your position in the contract with the customer. And we talk about the contract liability here. In one sense, I don't know, Hans, you had some thoughts about the contract liability. Do you want to just talk about that briefly before we move on?
Well, I think we've actually already partially covered that. So there's actually for the contract assets and liabilities for both of them, there's actually specific reporting requirements, which actually my dear friend Trevor, who's going to present a little bit different things today, but we have worked together on that for quite a while now for the disclosure reporting, which Bramasol has put together our proprietary reporting package. And so there are specific reporting requirements on that which we can fulfill. Yeah, I mean, basically, like I said, it is the difference between what you have recognized, what you were allowed to recognize as revenue under the guidelines, and what you have received as consideration.
Well, I think, you know what, since we're doing the dual screen here, let's bring it up again, and we'll show the balance sheet from the 606 perspective and the 605 perspective side by side. And I think that'll help folks see the difference here. There's 605 here. I'm going to drag it off to the left, and then here's the 606. So you can compare now and look at the varying ways that we hit the various GL accounts and what they're called. For example, here we've got unbilled receivables, and on the 606 side, we now have contract asset. On the left, the 605 side, we were going to deferred. On the right now, it's going to liability. And so you can imagine that if you start to do the comparative analysis of these various figures and look at the variance, which we'll talk about the concept of Part A and Part B. We're in Part A, by the way, and did you know there was a Part B? And we'll talk about Part B in a moment. Hans, before I move on, is there anything else that you wanted to comment here before we move on?
No, and I think the mileage anyways for you will vary, right? This is a very small, simple example because you might have slightly different structure on your balance sheet. As this will be very aggregated data in your external financial reporting, typically very often companies have just one specific business model, so they always have prepaid or they're always paying have postpaid or so you will actually typically probably not have all of these balances. You might have one balance, or you might choose to offset it on one side on the trade receivables rather than on the trade payables. So there's different ways of handling that. But I think the point is clear that you can see. So this is exactly the difference we want to have. We want to see on the balance sheet between the two accounting principles. And yeah, then obviously if we can see it already in a rather this is just an adapted standard reporting format, and you know that you can build out from there, right? The information is available. Yeah. So in
the slide deck, by the way, we did point out, and we do highlight, and if you can see here, we do highlight numbers to follow so you can follow the bouncing ball as opposed to in our live shots that we were just showing you. So I'm just going to go through these real quick. We've been discussing these, but in the dual reporting, and some key thoughts here is that once you get to income and balance sheet, we're finding that your company's specific revenue reporting components have a significant effect. For example, payment terms. In the example we were showing you, we have a net 60 payment term, so that causes the recognition at that point for the invoice as opposed to net 0. So there's a big distinction also in terms of that effect and also what you're going to report. And there's multiple reasons about what you're going to see and why, and what one is going to see, and there's an effect on your various reasoning about why you want to see it. So I referred to Part A and Part B. So we've been looking at Part A, and Part B is now really the bringing together in a variance report of those key GL accounts or figures that you want to show, and show them side by side in the same report, as opposed to 2 different balance sheet, which is what we've been doing, or 2 different income statements as we're doing today. So that's our next stop, is really to look at this Part B. Now, in our experience, we're finding that we're having to infer a lot of things in order to get that to fly, so at least our customers can see examples, and our prospects and people that are interested can see examples of what this would look like. But it's not exactly, as Hans was saying, your mileage will definitely vary, because we're finding every company is very unique out there, and how you account and look at things are very unique. But that's really, once you've got Part A done, then you can get to Part B, and that's really where the interesting action takes place. And there's a lot of things that you can see from that variance reporting when we get there, and that's something we'll be doing in the future, and developing that part about providing that as our overall solution set from Bramasol. When we talk about dual reporting, and before I move off and hand it over to Mr. Lovegrove, Hans, did you have any other thoughts, final thoughts here before we hand it over to Trevor?
Well, just like I zoomed in before, I could zoom out now. So, like I said, this is a very specific piece. It's basically just showing how RAR, if you're using account-based capabilities, account-based parallel reporting capabilities, what that will look like, right? So this did not get into the question how we got the opening balances, which is a question of using transition functionality or doing something custom, which may also be at some point the subject of a webinar. This did not get into the overall question, parallel run, more details, or modified versus full retrospective. All of those are wider subjects, and I think we have a rich ground still there, Chris, to cover, right, for future webinars.
Yep. And as we move forward now and hand it over to Trevor, one of the things to keep in mind is that now that we've got data elements and ways to look at it in place, the ways that we can look at it and roll it back out now are relevant and have germane bases in reality in the foundational aspects of SAP, so that I can pull it back and start to get that, what I'm calling Part B, for lack of a better description, that variance reporting. So at this point, I'm going to turn over to Trevor, and he can start to talk about those aspects. Trevor?
Hi guys, it's good to speak to you all, and I hope that excuse me, you're going to enjoy the next few minutes as I take you through the disclosure side of disclosure reporting and analytics side of what we've been doing.
John, hang on a second. John, keep me as presenter for right now, please. There you go. Go ahead, Trevor.
Okay, so what we're going to be doing is just taking you through some of the, and I'm not seeing anything yet, Chris.
There you go. Thanks, Trevor. Here you go.
Okay. Let's just go into the meat and potatoes of this and talk through some of the areas that we've been looking at from a reporting perspective firstly, and then we'll move on to some of the analytics stuff that we've been doing. So first of all, let's take a step back and talk about what type of reporting that we need to worry about when we're talking about revenue recognition. It breaks down into 2 areas. There's managing your business, which covers your operational reports, your waterfall reports, unrecognized revenue reports. Those sorts of things are required just to make sure that you're managing your business from a day-to-day basis. There is a need for different views that you're used to take into account all the new regulations. And to also troubleshoot areas of concern that you may have as a result of that. Then there's a straight set of disclosure reports that you require in order to comply with the new regulations. And the diagram here shows a breakdown of your statutory reports, your 10Ks and 10Qs, your financial statements. And then you've got the quantitative and qualitative and mixed reports that you may have. Excuse me. And those are the ways we've broken down the regulations. The regulations are basically broken down into a number of quantitative reports that you require in order to present the data that you have got in your system in a reportable manner, so that your auditor can reports are primarily descriptions of those quantitative reports, provide the rationale behind your thinking and so on. That's something very specific to yourselves as organizations. And then the mixed reports, fairly obviously, are a little bit of a mixture of the two. We've been focusing in on the quantitative side of the regulations, and we've developed some out-the-box reports that meet the regulations from our perspective, using obviously a middle-of-the-road data set that we have built ourselves for testing purposes. And if we could go to the next slide there, Chris. So breaking it down even more, we're using primarily RAR as the central source for all this information. There is some areas where that data, there's some additional data, organizational data that needs to be added, that can be extracted as well from ECC or other source systems in order to pull together all the information that you require. And as I said earlier, we've developed a package of key disclosure reports that meet the quantitative side excuse me, of the regulation requirements out of the box, which we would help you and enable you to get well up the curve to delivering the regulatory requirements for reporting once you've migrated to RAR. Now, let's take a step back. Because a lot of you will be thinking, oh, well, I don't need to formally report on anything until maybe March next year. That's my first quarter with the new regulations. You know, I've got plenty of time for this. I can counsel you on saying that actually, as part of your acceptance process, you should be looking at making sure that your reporting requirements are being met as part of your initial implementation, at least from a basic set of regulatory reports. So if you want to take our out-of-the-box reports, make sure that they are working appropriately, that the data is looking okay, that the reports are looking okay as part of that initial implementation. If out of that comes a need for additional changes, you know, custom work that you need to sort of reflect your specific implementation, and or to add some more operational depth so that you can start to look at in a lot more detail the data that you've already got in order to try and manage it in a way that resolves some of the issues that now you're looking at will actually try to resolve itself, or for you to start to resolve itself before you get to the first reporting cycle. So our recommendation here is to start thinking about reporting as part of your initial requirements gathering process, as part of your initial design, in order to make sure that you're ready for the first reporting cycle and it becomes part of your initial implementation process. So that's how we would recommend this going forward. So I think if you can go to the next slide, Chris.
Yep.
Okay.
I think we're going to hand it back over to you.
You're going to hand it back to me, and I'm going to just show you what we've been doing in some of the areas. Okay, so I'm going to show my screen. What we've essentially done is taken those reports that we've developed, and we've developed some waterfall reports. So some of those reports that you require to manage your business are waterfall reports and deferred revenue reports. And also, in order really to demonstrate this, we've also started to pull into our analytics the various out-of-the-box regulatory reports for disclosure. And for this demonstration purposes, I'm not going to go through all of those, but I've just pulled in one of the regulations, which is 4A, which is contract summary. So if I just start to delve into where we're going with revenue. So the deferred revenue report, this is what the deferred revenue report would look outside of, as we pulled it out of RAR. And we've had to develop this in order to reflect everything. I'm not going to go through the details here, but this is the basic report. As a result of pulling it into the analytics environment, we can now start to really get underneath some of this data, slice it as we wish, and start to see where some of the areas of concern might be as a result of having to report on our deferred revenue, again, from a revenue recognition perspective. And you can start to really figure out what's going on. Now, I'm not going to go through the analytics tool itself, but you can start to sort of delve into how I can filter on a particular company or a revenue particular contracts and so on. So you can really delve into some of your data in a way that starts to allow you to more effectively manage your business again as a result of this new piece of information that you have to develop as part of your revenue recognition reporting. Again, in an overview perspective, we've also produced some nice dashboards here that show, your top revenue customers, your revenue versus revenue accounts for the particular year on POB and material. Again, we're just using the same source data from that waterfall report that we pulled in order to really delve into this report. And the nice thing about this is that we can also, of course, with the analytics tool, and this is pretty standard here, we can also break some of this data down. As you can see, we can filter down and drill down to find out where some of the issues might be with my data. So that's how we could use the analytics level that we've developed to actually look into waterfall reporting and deferred revenue. In addition to that, we've also got this is just the regulation 4A, which is contract revenue summary. We basically created an environment where we can view the overall report itself that we've pulled from the system in order to see it as it will be pulled from a disclosure reporting perspective. And then as part of that, we can start to really slice and dice this data to actually figure out, okay, what is it really telling us? So I would characterize this as something that you would use from you've got your regulatory reports, and now you can really show how that data is made up and use this information to really feed into your qualitative reporting process that you have to do again as part of the regulation. So that's really all I wanted to show you today. You're going to get obviously all the details, so I'm going to hand back to John.
Yeah, Trevor, let's hang on 1 second. It's a beautiful chart, so let's hang on. A couple of questions. You and I have been on several team meetings with clients of late showing these dashboards. One of the things we always hear, and maybe you can talk about, is while the data that the folks are seeing here comes from RAR, it's not exclusively an RAR tool per se, meaning that we can import data from other places so that they can begin to see not just the deferred revenue per se or revenue affected by revenue recognition, but they can also begin to compare that to any other revenue and any other data they might want to feed into this tool and process. Is that correct?
That is correct. Yeah, this tool allows you to pull data for basically any source you wish. So you can either consolidate it as part of overall dashboards that you may already be producing, or, as you say, pull in organizational information where, for instance, if you really wanted to drill down through your organization, because as a disclosure report, you're really not breaking it down into the detail of your organization itself. But if you do want to report down to an organization group or a company, whatever, you can use this data, consolidate it with your organizational data, for instance, and really break this down into exactly where the problems are. So I hope that answers your question, John.
No, it does. And the other thing that you notice, for those attending, is at the bottom of the screen we show a comparison. And I think what we've done here, and Trevor and team have done a terrific job of showing, is how the data can be shown. And we used some quick sample data. But know that we can provide comparative data also. And with our vision of this concept of insight to action, you can begin to get the insights of how things change either period over period, or as Chris talked about with Hans, you begin to do your variance reporting. You could have a graphical, if you will, rendition of that information to allow you to quickly see what is going on and drill down and connect. So we thought it would be a great opportunity for everybody to see, what's going on and what we're working on, and know that these dashboards and tools are available to our customers, and we're happy to talk to you. So Trevor, thank you very much.
No, thank you.
Okay, so if you would turn it back to Chris, we'll start wrapping up. Chris?
Mm-hmm.
Back to Chris.
Back to you, Chris.
Thank you.
All right. So many of you are familiar, Chris, you can click through this. With this report, we've shown this many times, and here we are at the end of Q2, and many folks are looking at it saying, wow, as I look at this, I have a pilot, I have implementation, post-go live, it's all squashed together, and how am I going to make the new dates? So Chris, next slide. And when I was a kid growing up, and I'm sure many of you will recognize this, there was a famous book called Fortunately, Unfortunately. We're going to take it backwards and say unfortunately and fortunately. So Chris, next slide. So unfortunately, with regard to RAR, and by the way, this implies to the leasing as well, but RAR, unfortunately, auditors will prefer a single source of data, and what we're hearing is spreadsheets is not going to be one of the ones they like. That includes the SEC and our friends from the Big Four and others like RGP and others. Secondly, and maybe Hans or Chris, you might want to comment if you want, but we know from SAP, for example, that SAP SD RevRec, what many of you are familiar with, VF44 is going away. And we've run into a number of different clients who've said, we're just going to modify VF44 and use that tool. The reality is that tool does not support the 5-step model that's required under the new regulations. And in fact, as of somewhere around 2020, that VF44 and all of the VF4 asterisk type transactions will no longer be supported by SAP, meaning that SAP will no longer back them up as a way to do revenue recognition. It will be SAP RAR, FIRAR. And in addition to that, one of the things that you need to keep in mind is SD RevRec and RAR cannot exist in the same instance, and therefore one of the reasons why we recommend our clients use RAR for dual reporting is you want a simple and easy way to use that. Any thoughts, Chris, before we keep moving, or is that good?
No, nope, you got it right on the mark, John. Let's keep rolling, and we can add some comments towards the end.
All right. The other one is the date for, no, back up, please, real quick. The date is not moving. Remember that this is not an annual activity, but a quarterly activity. And if you don't comply, you will have material deficiencies in your 10Ks and 10Qs, and that will have an impact. All of you, next slide. What do you mean by will have an impact? Well, recently, the chief accountant of the SEC, Wes Bricker, made this statement. He said, and I'll paraphrase here, but essentially, investors tend to incorporate disclosure of ICFR deficiencies in the price they're willing to pay for a stock. For example, companies disclosing material weaknesses are more likely to experience an increased cost of capital. And in fact, they measured when they did SOX compliance that companies that failed to or disclosed internal control deficiencies had spreads on their loans of average of 28 basis points, a whole quarter of a percentage higher than those that did not. And additionally, when they looked at the experience they saw in cost of equity, that was almost a full percentage point more. And for companies that have large borrowings and large cash requirements in the hundreds of millions of dollars, you're talking about millions, $1 million plus a month that could have an impact on your borrowing rates. So there is an impact. It's been measured. It's factual. Next slide. But what Chief Bricker also said was that companies that disclosed and highlighted what they were going to do to remediate those internal deficiencies actually got a market-adjusted cost of 151 basis points, meaning that they got better costs. They got better results. Remediating companies also experienced increases in investment efficiency and operating performances, and they saw higher interest in their stock and confidence in their stock capabilities. So next slide. So the fortunately side of this is Bramasol can help. And if you notice in the statements that Mr. Bricker made, they talked about highlighting the idea of having a remediation effect. How can you do that? Well, number one is do a pilot. By executing a pilot, you'll have learnings you can use and provide insights. Those insights can be addressed in your disclosures. Do a limited scope project. Focus on addressing 3 or 4 top scenarios. Kick off a full project. Even by kicking off a full project today, if you use our RAR methodology that goes through the discover and assess processes early, one of the key outcomes is this concept of a paper model. That paper model, again, will allow you to have insights and information you can use in your disclosures. And finally, leverage our suite of pre-configured disclosure reports. While they are intended to be used with RAR and are certainly more powerful, we can use those to help you and guide you along the path of understanding what the data requirements are for disclosures. Next slide. Just quickly, you know who we are. We're Bramasol. We're the leaders in RevRec services. We have the experience, expertise, processes, and tools that we've talked about. Here's some comments about Bramasol from some pretty big companies, great customers that we've worked with. Next slide, please, Chris. For more information, I encourage you to check out our webinars. We have webinars on disclosures, variable consideration, etc., and our ongoing ebook series. With that, I will wrap up, and if there are any questions online, we'll take those. If not, we'll wrap up with my famous slide here. So I bring this slide up every time, folks, to tell you that being almost RevRec ready is not being RevRec ready. These guys all thought that their boats were almost waterproof, and as you can see, almost waterproof doesn't cut it. Almost RevRec ready won't cut it either for you. So my question is, always is to everybody, will you be RevRec ready on January 1st of 2018? Thank you to Chris, thank you to Hans and Trevor, and we look forward to seeing you in our next webinar. Have a great day.